Dealership lots across America are drowning under an unprecedented $867 billion worth of unsold vehicles right now. This isn't just another market correction. It's a full-blown automotive apocalypse that nobody saw coming. While mainstream media reports focus on minor sales dips, the reality on the ground is far more catastrophic. Dealers are paying a staggering $127,000 per month in floor plan interest alone just to keep their inventory financed. That's money that evaporates whether they sell a single vehicle or not. Last week, one of our viewers walked into a Chevrolet dealership in Texas and drove off with a loaded Silverado High Country for $39,900, a truck that would have commanded $66,000 just 8 months ago. And he's not alone. From coast to coast, we're tracking price collapses that would have seemed impossible during the pandemic-era shortages. But what's causing this sudden market implosion goes far deeper than simple supply and demand. The real story, the one automotive executives and Wall Street analysts are desperately trying to downplay, involves a perfect storm of overproduction, plummeting demand, and a financing system that's beginning to crack under its own weight. The numbers don't lie, and what they reveal about the next 6 months could save you thousands of dollars or cost you dearly if you make the wrong move at the wrong time. The situation has become so dire that major manufacturers are now secretly slashing production targets for 2025 and 2026 models. Internal documents from 3 of the biggest automakers show planned cuts of 22 to 35% across their most profitable truck and SUV lines, vehicles that once commanded $10,000 premiums over sticker price. But these production cuts won't help the mountain of metal already sitting on lots nationwide, depreciating by the day and draining dealer reserves. How did we get here? The answer begins with what happened during the pandemic, a period that fundamentally rewired how cars are sold in America and set the stage for today's market collapse. When microchip shortages and factory shutdowns limited production in 2020 and 2021, dealers discovered something unprecedented. They could make more money selling fewer cars at higher prices than they ever did moving volume. The entire business model flipped overnight. Gone were the days of haggling incentives and year-end clearance events. Instead, buyers faced a new reality, market adjustments that added thousands to the MSRP with no room for negotiation. A $42,000 Toyota Tacoma suddenly commanded $59,000. A Kia Telluride, a family SUV from a mainstream brand, regularly sold for $18,000 over sticker. Even basic transportation like the Honda Civic and Toyota Corolla saw markups of $5,000 or more. Industry data showed that by March 2022, an astounding 82% of new vehicles sold above retail price, with the average markup hitting $4,483. The automakers didn't just allow this, they actively encouraged it. During quarterly earnings calls, executives boasted about pricing discipline and optimized inventory strategies. Corporate speak for keeping production artificially low while maximizing profit per unit. Ford CEO Jim Farley told investors in February 2022, "We're not chasing volume, we're chasing margins." Translation, we're making more money selling fewer cars at higher prices. For a while, this strategy worked brilliantly for their bottom lines. Ford's gross profit margin jumped from 2.75% to 9.85% in a single year. General Motors cleared $10 billion in net income, a 55% increase, while selling 13% fewer vehicles. Stellantis reported $23.3 billion in adjusted operating income, demolishing their targets despite lower production. But there was a critical flaw in this business model that nobody wanted to acknowledge. It depended entirely on consumers' willingness and ability to pay these inflated prices indefinitely. And that assumption is now collapsing spectacularly, creating both a crisis for the industry and an historic opportunity for informed buyers. What most people don't realize is just how dramatically the numbers have changed in the past 60 days and why this sudden shift signals something much bigger than a temporary slump. Let me show you what's really happening on dealership lots across America and why time is running out for dealers drowning in unsold inventory. The dealer nightmare. Mike has been selling cars for 28 years. As the general manager of a mid-size Chevrolet dealership in Phoenix, he's weathered recessions, supply shortages, and manufacturer bankruptcies. But nothing prepared him for what he's facing now. Every morning at 6:45 a.m., Mike unlocks his office door and checks the numbers before his sales team arrives. And every morning, the same figure stares back at him, $127,000. That's his monthly floor plan interest payment. Money he owes the bank just to keep his inventory financed regardless of how many vehicles he sells. During the pandemic, floor plan interest was barely a consideration, Mike told me during a candid interview at his dealership. We had maybe 40 to 50 cars on the ground and they were all sold before they even arrived. Our floor plan bill was maybe $15,000 a month and we were making $6,000 profit per car. Today, Mike's lot holds 312 vehicles worth just under $14 million. Each one costs him between $50 and $80 per day in floor plan interest alone. That's before a single penny goes to staff salaries, facility costs, or advertising. Do the math. At $60 per day per vehicle, that's $18,720 daily just in interest. Over $560,000 monthly for his entire inventory. I'm paying more to park cars than I pay my entire sales force combined, Mike says, shaking his head. And I can't move them fast enough to make it back. The average new